All right, everybody, welcome back to the Crypto Hedge Fund Summit. It's been an awesome one so far. We've had a ton of awesome insights from asset allocators and managers, exchanges, and now we're going to take a look with a team over here at a real, just really intense crypto hedge fund. These guys are born and bred in the crypto markets. We've talked to guys in the traditional hedge fund world, but these guys are crypto in their veins through and through. That's all they focus on. DeFi, real world assets has been a big theme we've been talking about, and these guys are going to be able to speak to it. This is Space Whale Capital, and I'm joined by three gentlemen from Space Whale. I'll introduce them each here in just a moment. First up, we've got Nick Garcia, who is really heading up the fund as their general partner and CIO. So, Nick, thanks for joining us at the Hedge Fund Summit. How's it going?
Thanks, Bryce. Nice to be here. Thanks for having us, man.
You bet. We got Kevin Kolb, who's really running the operations over there. Everything that maybe isn't going on in the front of the house, but going on in the back of the house, Kevin makes sure it gets done. So, Kevin, reporting for duty. How are you doing, sir?
How you doing, Bryce? Thanks for having us on again, man. And it was nice meeting in Austin, by the way.
Yeah, that was a ton of fun. I love always, we do the podcast virtually and you can always meet people, but getting out, having a drink together, shooting the shit, nothing better than that. And we got one of the newer members here, Space Whale Capital, Jordan, who is an analyst and a researcher. Jordan, how are you doing, my friend?
I'm doing good, Thanks for having us back, and good to be here.
Yeah, no, I just want to get your guys' pulse here. You guys are we on the other side of the bear market? Did you guys navigate the ship? I mean, there was countless hedge funds that blew up. There was countless exchanges that blew up. Now here we are, July of 2023. Are we firmly on the other side of the bear market? Nick, why don't we start with you?
Yeah, I mean, look, I think, looking back at what happened over the last 12 plus months, it's incredible to look at like what the actions of few have done in terms of repercussions across the entire ecosystem.
Yeah.
In my opinion, I think we have passed the worst of it for sure. I think on a price basis, we've definitely bottomed. Well, definitely is a difficult term to say, but I feel highly confident that we've bottomed.
Nothing you hear is financial advice.
I'm certainly on the positive side that we've passed the bottom there, and I think on the narrative side, there's a certain aspect to like, honestly, how much worse can it get? The SEC has come after like pretty much every major player across the space, and now really not looking so great for it. So I think from a narrative perspective, from a price perspective, I think we've passed the bottom. I don't think it's going to be straight up only from here, obviously, although we'd love that. I think, it will have its trials and tribulations, but, on a long-term time frame basis, I think we are past the bottom and headed towards sort of the new motherland here, which, hopefully, I think over the next sort of 12 to 24 months should play out pretty strongly.
And Nick, just to follow back up on one point, like now that we kind of are shifting the market environment, if you will, from really just kind of a dreadful bear market to kind of this transition, how were you thinking about managing risk during that period? How were you trying to, create the best returns during that down market? And then kind of how does that shift as we turn back up into what looks to be more of an upwards trending market?
Yeah, I mean, I think, unlike most funds, we truly, do a majority of our strategies on chain, our allocations on chain. And so, we really avoided a lot of the headaches that happened last year in terms of some of these like centralized blowups that happened. We never did, lending on a centralized basis. All that stuff we really did on chain. So we were able to sort of navigate that pretty well, all in all. It wasn't easy for everyone, but I think compared to most, I think we were able to navigate that very well, primarily because we do a lot of things on chain, but also because as it was pretty clear that the top had sort of passed and sort of things were starting to crumble, we took a majority of our portfolio over to stables and concentrated those across, non-directional yields, delta neutral yields, both in DeFi and particularly in real world assets. It's something we really scaled into heavily at that time. So we were able to avoid a lot of the volatility on the price action side and a lot of sort of the blowups on the custodial and sort of centralized lending side of things, which honestly, risk management on that perspective really helped us outperform on the downside and on that. So, looking back, I think we'll see a lot more of that going forward. I think we'll see a lot more of these products available on chain. I think we'll see a lot more of these products available on a non-custodial basis. As people are legitimately traumatized from what happened. I mean, even though we did a lot of things on chain, it's not like we expected every single thing to happen that did. I mean, there was some things that were a bit more obvious than others, but I do think it legitimately traumatized people. And through the bear market, we've seen a lot of developments on, perp products, option products, non-custodial exchanges coming out, and sort of different solutions that will hopefully solve some of these issues that we saw.
Yeah, no, it was kind of incredible to watch. Incredible, like a horrifyingly incredible to watch as these things were unwinding. A lot of these people got, stuck with a bunch of bad debt. Right now, there's bankruptcies being filed, and people who thought that, they were lending money to somebody who was good for it. Now it's, it's all a fugazi. But guess what? All the decentralized lenders like Maker and Aave, like, they all kept working. They were actually the senior tranche of creditors. They were getting paid back first. And I thought that was really, a cool dynamic to watch unfold in real time, is like, people were, paying back their DeFi protocols before really their centralized, counterparties, if you will. And why do you think that is? Like, I don't know if, you guys have a thought of why that actually was occurring. Do they fear actually the total loss of their collateral, and, versus like maybe that, in the meat space, they'll be able to like kind of, work it out? Or what do you think was really driving those decisions?
I mean, I can take a quick stab, and, guys feel free to jump in, but I think, the short answer of it is that, like, most of these things on chain are all done on an over collateralized basis, right? The protocols don't really care who you are. They care that they have enough collateral, they can liquidate you. It doesn't matter what you choose to do, right? So naturally, like, creditors aren't incentivized, those that are specifically acting in the best interest of their clients, to get the most value out of the liquidation as possible. And so naturally, you're trying to get these over collateralized loans paid back first, because that means more money that you have on hand to optimize sort of the credit liquidation process.
Yeah, makes a ton of sense. And kind of going back to one of the earlier things that you were mentioning, things are looking up. We've got a new kind of narrative that's going on. Like, we've got some of the bad guys behind us. We've cleaned up the act. And it feels like, to me, again, we're here at the end of July. Things like the crypto market just got spanked with a bunch of good news. Like, we had the Bitcoin ETF that, 10, institutions just tried to roll out. A few of them are like $1 trillion institutions: BlackRock, Fidelity, Invesco. We have, what else? The Bitcoin halving coming up. We had XRP come out with all this bullish news. So, Jordan, let me pick your mind real quick. What are we seeing just in terms of, market news? And does it actually match what's going on with kind of the flows? Are people buying this sort of good news? And do you think that there might be higher prices towards the end of this year?
Well, there was like a weird little mismatch recently with the XRP news, right? Like, we got that great news flow come out, and then Bitcoin couldn't even break the range of between 29K to like 31K. And a lot of people, that was like a little bit confusing. But one thing that's been going on across the board in the crypto markets is that if you look at like the cross section of assets across the space, most coins are up pretty big over the past like 30 days. So there's like a decent amount of profits to be taken off the table. And generally speaking, when here's like an example of like a data point that like we look at internally, is if you look at like Binance perps, and whenever there's 90% of coins that are in profit over the past 30 days, it's generally not a great time to add risk. So before the XRP news came out, a lot of coins we were like near that 90% like marker. So, for us, if you want to talk about ways we manage risk as well internally, we're like, maybe we're wrong, right? Maybe the data point is wrong, and like this news flow just breaks through the data point. But, internally we had the discussion, does this make a ton of sense to add it range highs up here for Bitcoin? And then, we had the reversion and just back to more chop. Mm-hmm. I generally think, to Nick's point, that I think the lows are in, if you look at historical context, like for example, the realized cap, which is the cost basis of Bitcoin holders, for example, usually once Bitcoin breaks above it, it rarely revisits the realized price. But once it breaks above it, convincingly at least, right? So you usually don't even get a revisit of that once you break above the realized price. And you saw fees pick up on chain. Some of that had to do with the ordinals action that was going on. It's kind of ticked down a little bit recently, but generally speaking, I'm pretty high conviction that we won't revisit the lows. And I think, that's not even it's not even too contrarian at this point. And, the other point that I think I brought up on the last time we jumped on was the cost to borrow, which if you look at the perps market, the funding rate, generally, if you look at funding rates and you know how to parse through the data, there are no free rides in crypto. You pay, if you're bullish, funding rates go up, right? And in bear markets, it's more expensive to short. And what we've seen is a consistent move upwards in funding rates since the beginning of this year too. So I think in the general outlook, it's kind of just keep your head on a swivel, but don't get too bearish. And look at deep drops in price as opportunities to just accumulate more, but not to not blow up in the meantime, right?
Yeah.
So that way, when the bull comes around, Bitcoin breaks all-time highs, everyone goes max risk on. Your barber is cutting your hair, telling you he made a 10x on Cardano or something like that. You're ready to go, and you have some cash to deploy, and bullets still left in the holster.
Dude, it's such a funny thing that you mentioned the barber. Literally, if I would have taken a signal like that in May of 2021, I was checking out of a hotel in Vegas, and my bellhop gets to the door and he recognizes me. He's like, "Hey, dude, you're Bryce. I listen to your podcast. I follow you on YouTube." And I was like, "Oh my gosh." He's like, "Let's get a picture. You're changing my life. I'm getting a house in the Ozarks, all this crazy shit." And I'm like, "Wow, that was so surreal. Crypto's going mainstream." That was literally the top right before Luna collapsed. And I was like, man, so everybody who's watching, if you guys take signals like that in your life, use them, right? They're really strong indicators of sentiment in the market. And clearly things were overblown. But then on the flip side, I'll get people in the bear markets. It happens every time who are like, "Oh, I know Bryce is the crypto guy. Let's check on in him." I got so many texts during the FTX collapse. People always kind of morbid curiosity looking over, seeing if you blew up yet or anything like that. And so that was a great time to be a buyer, right? I mean, that's right towards the bottom of the market. And so when, always use those indicators. And I'm sure you guys have those people in your life, when mom texts you, "Is everything okay with crypto?" or whatever, that's a good time to be buying. But is there any other indicators that you guys look at, or indications of, how do you know when it's a good time to be buying, right? And like you said, you knew, because certain things were overblown towards the high of the range, you couldn't break out convincingly, you knew it wasn't a good time to add risk. But do you guys look at anything else to say, "Hey, now's a good time to go risk on"?
I would generally say it's a combination of metrics, right? Generally speaking, the best times to buy are when multiple metrics, like 3 to 5 or 6 metrics, they all line up, and it's all right, price has been clobbered, but there's a sign of a trend shift, basically. And that's kind of the stuff that we look for when we get very high conviction. That's when we like to make our bigger bets. Generally speaking, though, when things kind of get towards the middle, in terms of conviction of bullishness, or at the top where we're obviously just outright bears or whatever, that's when we kind of want to we tone down the level of exposure we like to have in the market, at least for the discretionary part of the book. But we do, I'm trying to think of any other metrics that we have that we use. I was
going to say, one of the things that I just picked up on there that sounded, worth repeating is that whenever you might have a set of indicators that you're looking at, look for Confluence, right? Look for hey, 3, 4, 5 of them are all pointing in the same direction. And it's just starting, starting to rip above the 50 or whatever it is. And they're all kind of starting to move in the same direction. And then you could kind of use that as a little bit of a confluence, as opposed to just looking at one indicator where you might just get faked out a little bit.
Yeah. You could look at for example, let's just list them off, right? Some on-chain data, something like the realized price, or you can, one thing we like to look at a lot is it's on the Glassnode website on Workbench. It's called the market realized gradient, which it basically compares the performance of market cap versus the realized cap over a 14 or 28 day period, right? So effectively, whenever realized cap has outperformed the market cap over 14 or 28 days, it's a good time to get bearish, because it's telling you the cost basis of holders has gone up more than the price has, right?
Got it.
So it starts to tell you things are getting a little top heavy. But other things you can look at, for example, on the XRP breakout at the top of the range, open interest on BTC and ETH ripped through the roof, right? So it was a very perps driven move. It wasn't very, it wasn't insanely spot driven by the looks of it. And then you can just look at funding rates. You can look at the average funding rate across multiple assets to see all right, well, people are just really adding risk here as well. So, those are different ways you can skin the cat, so to speak.
Do you ever have like, oh, I'm going to buy the 50-day breakout or buy the retest of the 20-day moving average? Or do you not really look at like technical indicators like that? Or are you more just an on-chain and kind of funding rates type strategies?
No, I actually do like technicals. I back in the day when you first get into crypto, it's like the only thing you know about. Like I feel like I got into the space in 2016, and I remember the only thing people would talk about is TA.
For
But
sure.
keep in mind because there was like very few data providers, right? Like perps didn't exist. The Glassnode didn't exist. Coinmetrics, I don't think came out till like late 2016, 2017. So there wasn't really any other way to look at stuff. So back then it was actually a relatively easy space because there was no other tools at your disposal. But yeah, I do like technical analysis. And I think it's useful to see people respect horizontal levels, right? Like we've seen that in this range that's been going on. The top and bottom of the range has been horizontal. So it's a good way to just add another piece of Confluence. And then, depending on which metrics you prefer, you can weight them accordingly.
Yeah.
Yeah.
I guess open up the floor. This one will go for anybody, but I guess the question I get a lot is like, how do you know in a sea of 25,000 different cryptocurrencies, like shit, how do you know which one is worth buying? Is there a fundamental analysis that you should do? Is it all just looking at liquidity and, like you said, all these indicators, or is there actually a level of fundamental analysis that goes into the selection? Yeah. What do you guys think?
I mean, I can jump in with a quick stab at that. I mean, I think, and this almost is like an extension of the last question you guys were talking about, but to me, it largely comes down to this, blend of like fundamental factors and narrative factors.
Yeah.
Right. So like there are, profitability factors, token value accrual factors, supply release schedule factors. Like there are actually like fundamental data points that are really helpful in understanding like what direction the price is going to go in. But there's also narrative points, where like there have been a lot of scenarios where like fundamentally things make sense, but like narratively, there are things that may be going against it. And so it takes time. I think the biggest beauty of things is actually when you get an alignment of these like fundamental and narrative driven things, especially when those things sort of cross against multiple protocols and chains. So like one example that I'll sort of specify is sort of this like growth of RWA and what that means, right? So when we started, Fortunify back in 2020, RWA was not a thing, right? This is like not an industry. This is like not a growing trend at the time. It was definitely something that was, for all intensive purposes, a bit early. I mean, even in 2018, there was an original push for RWA, which is way too early. Even if like fundamentally, some of it makes sense. What we're seeing today is RWA is hyperscaling, right? We're seeing demand on chain from different protocols. We're seeing, all these large public institutions from Bank of America to Citi to, literally AllianceBernstein. I mean, BCG, everyone that are putting out, legitimate projections of, the total market opportunity of these things being at like 16 trillion, by 2030, which is a significant, projection from the markets today. And it doesn't come into account a lot of, sort of the integrations with permissionless networks that we're seeing and that we're enabling through Fortunify. So I think this number can be significantly larger. So the beauty here of bringing this together is that fundamentally, right, RWAs make a lot of sense. Narratively, they now make a lot of sense. And what we're seeing is that these things are now getting integrated across different layer ones and layer twos and different DeFi protocols, right? So why has Maker been doing pretty well? Well, they've, turned profitable. They have a buyback mechanism, which is, taking 15 million and buying back Maker DAI LPs, which, is a pretty sizable supply chunk as that continues to grow, which will have a positive, impact on price. I'm assuming, I think it's a fair assumption. And, Compound has seen some pretty big success there, right? We've seen Leshner spin out and spin up a, money market fund that will be open to on-chain investors, supposedly. And so I think there is like an expectation that this will be integrated into Compound. We've seen Aave integrating real world assets with Centrifuge. And so both of those are doing really well. We have our assets from Fortunify on both Centrifuge and Aave today, and Maker as well, actually. So this integration of things is sort of like getting an empowerment across the DeFi layer one protocols, which we're now seeing that sort of translate into price action for those. So that's just, an example that I'll point out of stars aligning in a pretty supreme way, which have not been priced in my opinion, to the markets yet.
Yeah, that's incredible. And it was funny because as you're talking about RWAs, I was thinking, oh yeah, I'm going to ask him like, what are some good protocols that are crushing it? And then bam, you followed it up right there with, the Aves, the Makers, the Compounds of the world. To me, it really feels like a renaissance or a rebirth of, ETH DeFi. The OG Synthetics is getting new front ends and fixing up all their crummy user interface and all that kind of stuff. So yeah, now we're going into maybe the age of more usability and just better apps and stuff. But I think for people at home who are watching this, they might be curious, like, hey, like, RWAs, it sounds good in theory. And maybe people have credit cards that work wherever they want, and they have, the ability to get mortgages and loans and small business, help and stuff. And so they might not see the outset. But people in the developing world, like, need access to a lot of these technologies that all you need to get a loan is, your wallet address. You don't need certain levels of, identification or credit checks and all that stuff that, developing world can't really do. So I think the technology is, on the long tail going to be super, super beneficial to helping like just GDP across the world. But is there a way, and this might sound short-minded, but I know a lot of people are thinking it, is there a way to make money in the short term by using these protocols? Like, I know there was yield farming and liquidity mining, and everybody was making buku bucks. Is there a new way to do that with RWA?
There was yield
real-world
farming.
assets?
So here's what happened, right? Like there was yield farming. What happened? Well, like what happened is that like a majority of the underlying yields associated with these yield farms were like highly inflationary base yields, right? And so as the market collapsed, those yields collapsed because the underlying inflation is worth less effectively. And so you get this dilutive selling sort of cycle, which like crashes these yields. One of the beauties of RWA, right, is that by introducing a high quality base yield to these protocols, I call it the protocolization of RWA, right? You now have an actual, what we before used to look at for high quality protocols, like, revenue, profitability, how can they drive value to their token? Now by introducing RWAs to these protocols, there is a real underlying source of yield, which means there's a lot more users that come to the platform they get attracted to it. And then that sort of compounds into a lot of other things, right? So this protocolization of RWA means that like with an underlying high quality yield, you can have different incentives on top of that, which get to a much higher yield, but you still have this high quality base underlying yield, which, maybe back in the day was like profitability of a protocol. These days it could be profitability plus RWA plus incentives. And so you have a much more legitimate stack of yields, if you will, that is, what I think is sort of creating a renaissance here for DeFi 1.0 at least.
Yeah, no, I'm excited about it. Now what, Kev, maybe I'll go to you real quick. In terms of just like the landscape for investor appetite, are you guys fielding a lot of calls inbound? Are people scared, trying to, maybe even, withdraw their money from the fund? Or like, what's, the overall sentiment of investors that you've kind of been able to interact with in the past couple months, at least?
Yeah, I mean, obviously 2022 was tough for fundraising. People were taking a hit, weren't really looking to deploy with the market kind of in shambles. From what we've seen recently, a lot of investors are looking for a more stable kind of yield fund. So that's kind of what we adapted to, because investors, if they're looking for volatility, if they're looking for exposure to the market, they can always just buy Bitcoin or ETH on their own. Some things that they can't do, is participate in certain reward asset pools, for example, or different DeFi protocols. So that's what we're kind of trying to cater to right now, delivering, a low risk base yield, uncorrelated to the market, and just delivering positive returns month over month.
Yeah. And is, I'm curious, like, how does a high government interest rate or a high, like, benchmark, I guess, how does that affect a credit fund or something that might be structured like that? Because, or market neutral fund, because if it's so easy to get, 4% yield from a government bond, if you go out the risk curve, I guess it makes it, a lot harder to get a higher yield than that. And you take on a lot extra risk, maybe. Do you guys find any difficulties like in a rising rate environment for strategies like that?
Yeah, I mean, it's a fair point, and we have seen a lot of funds, just electing to hold treasury and get that 4 or 5% base yield instead. But when it comes down to it, we're still going to outperform that pretty massively. And I'll let maybe Nick take it from there on the interest rate front.
Yeah, I mean, I just think that, right, if your base like risk rate of return obviously is increasing because you can get treasuries, right? Like, what do tokenized treasuries on chain enable, for example, right? We, at Fortunify just recently announced that we're launching tokenized treasuries on Canto. And Canto has a whole stablecoin market, a money market. They have, several different DeFi sort of applications there. And this sort of same concept exists, across sort of the crypto sector, right? And so being able to take a treasury, for example, and borrow a yielding stablecoin against that and create a low leverage but still high underlying treasury, you can get to like a double-digit yield with the same underlying risk, simply by managing sort of the on-chain risks associated with accessing these things, which we've set up a good infrastructure to do here at the fund. And so we've been able to significantly outperform. I mean, it's not just RWA strategies either, right? There are different cross-chain emerging DeFi protocols that have really unique opportunities that, I think a lot of the folks in the market just are not aware of, but we do a lot on the venture side as well, which, has given us access and insights to a lot of these different early stage emerging DeFi protocol yields. Obviously, we do a lot of research as well in the market to find alpha, but we found a lot of great opportunities allocating stable coins, in some cases spot, that will hedge as well to these protocols, and doing some cross protocol operations, some within protocol optimizations of these yields to achieve much higher double-digit yields than, for example, holding treasuries, with the idea of capturing alpha in crypto, but managing that downside risk as well, and offering investors sort of an alternative place to park capital. So that's what Kevin was mentioning, like one of the newer strategies we actually just launched, which we have been in fact able to raise capital from a couple fund of funds this year in terms of bringing them into that vehicle. So it's not been easy broadly to raise capital, but we've seen demand there.
Awesome. Jordan, let me pick your brain real quick on just some tools that you use to analyze the market. I know you guys have a lot of paid premium tools probably, but are there any that maybe also free to use or have some lower level options that, all the good citizens of Crypt Nation who are watching could go check out on their own?
I'll be honest. So most of what I do is I operate out of APIs. So I use like the Binance API, the Deribit API, the Bybit API.
So you build everything yourself.
Yeah. We build everything internally, and we have our own
cool.
internal website just hosting all these different metrics. It's probably, I don't know, it's like 20 tabs now or something like that.
That's
so
awesome.
We do that. We use DeFi Llama. So all this stuff is free. And one thing I think that people don't realize, especially if you're like pretty comfortable with Excel, right, is that you can pick up Python coding to pull from these APIs like pretty seamlessly. It's not that difficult. I know that's like a pretty lame answer that I think a lot of people probably don't want to hear, but
it's a very
a lot
hedge
of
fund answer.
Yeah, well, a lot of
we don't trust any other data. We do it all on ourselves. Just smart.
Well, you can
smart
just
money.
get more. You get more like customized stuff, right? Because it's like the same thing. Like, let's say you buy a book and you buy like, hopefully nobody gets mad at me for saying this. Something like how to make friends and how to win friends and influence people or something like that. Like if everybody reads that book, you're not getting a ton of alpha by being one of like a billion people that has read that book, right? So what's nice about being able to pull the raw data directly from the source, and keep in mind all these exchanges at a minimum provide their API data for free, is that you can make some really custom stuff and get some really unique looks at the market. But like, honestly, like if you really want to keep it simple, I like Glassnode a lot. I'm a little bit biased. I worked there for a bit. But Glassnode's got a decent set of data for relatively affordable prices. And otherwise, DeFi Llama is something that we're pretty fond of as well. They have a pretty robust data set. And I think if I'm not mistaken, we played around with it recently. I haven't dove in deep as much as I should have into the AI stuff, but I know they've open AI plugin, if I'm not mistaken. So that is probably the best. If you want to do it the best way, in my opinion, it's to just start pulling from the APIs and get the data raw yourself and start playing with it. But yeah, very I guess very nerdy hedge fundy answer.
No, hey, it makes sense. DIY, do it yourself. I think that's the best. So we covered a lot. There's a lot of different ways to look at the market right now, I think we could all kind of agree, you know, in the near term, definitely bullish, you know, maybe some slight room for breathing in the market. But long term, I mean, especially when you consider just the golden age period we're moving into with BlackRock, right? And all this, you know, great stuff. Hopefully we don't get shut down or else the market's going to nuke on that filing, but we'll see. But the Bitcoin halving, that's the last thing I wanted to touch on while I still have you guys, because, you know, every 4 years this thing happens, in about, you know, 15 or 18 months after the halving happens, you're like, you know, at the top of the market, everybody's losing their minds. And so that's just about, you know, the halving, I think, is 9 months away. Do you guys have any general thoughts on what's going on with the halving, or can you inform anybody about your guys' view of how this moves the market?
Well, I think one thing that's to be said about the halving is that, you know, with each halving, I think, you know, obviously less and less coins are hitting the market from miners. And I think the mining market, I think, keep in mind, I'm not an expert on the
Bitcoin
mining.
miners.
Yeah, Bitcoin miners. Yeah, the Bitcoin mining market is much more efficient than it used to be, right? You have all these different ways to hedge exposure. The options market has exploded in terms of people using it now. I know Deribit, the open interest is almost surpassed like Binance total open interest for Bitcoin, or maybe it already has. So there's all these different ways for miners to hedge out their exposure. So I'd assume that that it doesn't have as much of an impact as it has historically, just because there's all these different ways to manage the risk for miners. And it's not as much of a dumb market anymore in terms of like the miners, you know, this does tend to happen, but like if you look at historical data, for example, you know, the easiest way to check that if miners are getting squeezed or not is how fast block times are coming in, right? If block times get really slow, miners are getting squeezed really bad. And one thing that we've seen over time, outside of that large China ban that happened right after the Coinbase IPO when the market nuked.
Yeah, like May 2021.
Yeah, you'll notice though, if you like track block times and you put like some sort of smooth moving average on it, the spikes don't get as crazy anymore. And that I think is a testament to the fact that the market has just become substantially more efficient in that regard. Obviously, empirically, I don't really have like the internal data from these miners to prove that. But just from like looking from a bird's eye view, so that's kind of my expectation. And I think we're perfectly lined up for just another go of another bull run right around the halving. You know, just even expanding further outwards. But yeah, that's kind of, those are my thoughts on it.
I'll just add a couple like slightly bullish leaning thoughts on top of that, since that was a more risk managed perspective there, I would say.
That was a more tempered answer than what I'm about to give.
I would say that, like, I mean, if you keep it simple, right, this is all about supply and demand. Like historically, in every other cycle we've ever been, where we're coming into a halvening, like that was the one thing that got us out of the bear market, right? It was the halvening that was going to get us out of the bear market. And like every bear market, like it was, you know, could have been the last one, like until now, right? So I think the supply and demand, you know, dynamics have shifted significantly, where like supply obviously is just obviously continue to get more and more in favor, right? So we have a halvening of supply, but, you know, demand, I think, has never had like a real chance of like hyper growing the way that it does going into this next cycle, with these institutions taking a look and these ETF products coming out. I mean, like what GBTC did, and obviously it is a little different than GBTC, but like in effect, these legitimately larger institutions that are going to offer this and now effectively create a global sales force to shill Bitcoin and likely ETH, you know, after that, is I think like an unheard of growth in demand that like we haven't seen going into previous halvenings. So, you know, it wouldn't surprise me if this one surprised us a little bit more than the other ones did.
Let's go. I love that. Wouldn't surprise me if we're all surprised. I love it. That's the Bitcoin mantra. So Kevin, let me wrap things up with you, man. How do people get involved with Space Whale Capital? If they're out there, maybe they're watching, they're impressed by you guys, they want to learn more about either following you guys or maybe investing with you guys. Is that even possible?
Yeah, sure. I mean, they can check out our website, spacewhale.capital, kind of see some of our select portfolio companies, learn a little bit more about what we're doing over there, learn a little bit more about the team, and you can just contact us through there.
Incredible. Sounds good. Well, boys, thank you for joining us here at the Crypto Hedge Fund Summit. We'll have you back next year. And take care of yourself.
Thanks, Bryce.
Awesome. Thanks, Bryce.
Thank you.